from your perspective, left side on Antti is Marlies van Boven. She's at FTSE Russell, Managing Director of Research and Analytics. She and her team advises institutional clients on strategies with a focus on smart beta and sustainable investment solutions. Then we have Anna Harris from State Street Global Advisors, and she's heading the equity portfolio strategies indexing, and she's managing a team dedicating to develop your smart beta and index strategies together with the ESG equity investment strategies. And then we have so let me see here. Ole Christian Bech-Moen from NBIM, also known as the Petroleum Fund in Norway. And Ole Christian is the CIO, and the fund has several CIOs, but you are for allocation strategies at the fund. So, and I'll try to moderate this. We will have a few topics here, and at the end, we would like to also invite the audience to chip in. So my first comment, and I'm of course very curious about, I know the academic evidence, and academics tends to focus on paper portfolios, even though we care about transactions cost and liquidity, etc. But I'm curious about taking these factor investing strategies in practice and actually how to do it. So one big question in the academic literature is how many factors are there? We saw 4 themes today, Antti. What about the evidence? And I'd like to ask Marlies maybe to start on thinking about the academic evidence historically and how we can maybe put it into the different factors. Are we 4 themes, or are we having more themes?
Sounds like 3 questions in one. Yeah, regarding the academic evidence, I think we've all heard a few presentations about the factor zoo the last few years, and Luzang has written a few papers there. Harvey did a recent study. He documented 400 factors, but after correcting for data snooping bias and doing some extra statistics, meaning that you need a higher hurdle rate for factors to be significant, it came out that really the pharma-French factors and the factors that are well established, like Antti discussed, are the ones that survive. So it's very easy to backtest and come up with hundreds of factors, but if they don't have any economic meaning, they're very unlikely to persist. They don't even survive the statistical scrutiny, but I think it's very important that factors have a sound economic grounding, so there's a reason for them to exist and more likely to persist. The well-documented in academic research, academics like to undermine each other, so if a factor survives the test of time, they're probably, and they've been proven across regions over time, they're more likely to persist.
Anna?
Yeah, I guess so. What I kind of work on, and the teams I work with around the equities piece. So probably more the kind of style factors that Antti was mentioning, and we kind of stick around those: value, volatility, momentum, quality, and size. And again, I think for us the burden of evidence is to see it evidenced in academic research, so not just our own, that we will do, and we will test it over time, different markets, different time periods, try the in-sample and out-of-sample as well when data is enough and available. And really, I guess the challenge is, again, testing those factors, showing the evidence, and really for us is managing investors' expectations, how much they can actually expect to receive at the end of their investments or over a certain cycle. And for us, transaction costs become extremely important. And also what is important as well is that most investors, even if they look at evidence from an academic perspective that is long short, most investors can't actually go long short. Most investors may have restrictions from a governance perspective, the ability to monitor or internal and in-house knowledge about how to monitor the short side. So really, I guess what I have to do as a more client-facing is to try to help them go from that journey of understanding what factors are, which are documented, and bring them to their world, into their constraints, and the real world constraints like transaction costs, and what vehicles they can actually invest in. See again, does it make sense for them? And again, and we'll talk a little bit more about it when we talk about vehicles and what investors are doing, but it may not be the right solution for all investors, because again, they might have constraints in the way that they operate, in the way that they look at performance. They may not be able to allow themselves to actually participate in some of the potential upside, which, especially if you stay in the long-short space, might be more limited.
On the limitations, Ole Christian, so it seems like you're a special investor, and I would guess that some factors will be harder for you than others, say small, the size factor. How do you think about the factor investing and the evidence coming from academia?
Sure, so I think both Antti and Marlies have highlighted that it's important with empirical evidence, and it's important with sound economic rationale for at least us to invest in a factor. Clearly, there aren't 400 factors out there, right? So there are fewer, as I've been mentioned several times this day. But as Anna said, this is really investor specific, which factors that are suited. And for us, we care about which factors that are suited for our fund. And then you need to understand part of the background. We're a large fund. We're $1 trillion now. That puts some limitations on it. And we're a 70-30 fund, so we have 70% in equities to start with. So all factors not correlated with equity risk are of interest within this space of well-documented factors. And also T-cost is important for us. We just cannot implement really high turnover strategies, at least in all sectors and segments out there.
So may I just interrupt you, but do you have the word factor in your investment directives from the Ministry of Finance?
So we have in our mandate, it says that we should have a diversified portfolio across different risk factors. So that can be interpreted that we should actually have top-down intentional tilts towards factors. And since 2012, we have had that in our portfolio. Value, what we call quality, and also size. So we are able to have a size exposure, a small cap exposure. Even though we're large, it just takes a lot of time building it up. But of course, the churn in that portfolio, the underweight, overweight, isn't that high, so it's doable for us.
So value was mentioned, and value we've mentioned several times today. We talked about the historical evidence, we talked about the recent evidence and going forward. Who wants to take the question of will value sort of be in fashion again, meaning giving some returns? Is it time for you, maybe Antti, to...
Yeah, so when one looks at data, one can either look at it from sort of value spread perspective, whether it's contrarian, attractive, or factor momentum, and they tend to give opposite signals. So something that has sucked the last year, then sort of has got negative signal from that momentum, but somehow it's starting to look quite attractive then from some value spread perspective. Overall, we'd say we believe in it as much as we have always believed, and those sort of pretty much net out. It's a good part of the package. We don't believe that this sort of the stories that have been put forward now mean that value will never work again. We like it as one piece of a well-diversified style portfolio, and certainly would stick with it. Actually, I would say that it's the most conventional style of all these factors out there, stock selection value. People who don't believe in quant stuff, they think, oh, this is Warren Buffett and Ben Graham strategy. So that has given more patience to many investors than if the sources of factor investing losses had come from anything else, highly diversified or some other particular factor. That was sort of the silver lining in this bad performance over the last 2 years. That this source led to more patience than anything else would have.
May I chip in on this one?
Absolutely.
So I agree with much of what Antti says, but I think it's also, you have to always question whether things have changed structurally. I think we cannot just lean back and look at the historical evidence. We just need to, when we see periods like this, we need to analyze very thoroughly, all the time, has something changed? I think you mentioned that in your introduction, Antti, so I think that's really important. Secondly, I think this is a test of whether you managed, prior to this long drawdown in value, to explain to your key stakeholders what type of risk they took on. So this is a test now, whether you did a good job then. In addition, it's a test now whether you scaled your risk factor portfolio the proper way back then when you put it on.
And how patient is the stakeholder?
The more transparent you have been, the more you have been upfront of what you're doing, the better you have been to explaining what type of risk this involves. I think the more patient the stakeholders are.
Marlies and Anna, happy to think about the patience here on value and also maybe a little bit about the value momentum have historically had negative correlation, and then recently it sort of shifted and become positive, and it's sort of I guess sort of my thoughts go to the Quant Crisis in 2007 in August, and I'm thinking about, is that what's going on, or is it very different?
It's just kind of picking up on what Ossi was saying in terms of, I think what in terms of when we've been implementing some of the smart beta strategies, where again, more broader brush, trying to harvest these factors in long-only equity space, I think what we've also been learning about sometimes how factors behave relative to each other. So to the point that what you have to understand is that on the risk side, have you allocated risk appropriately according to factors? So we've heard about static exposure, so basically where you do equally weighting. And actually what we found, especially in more recent terms, so kind of more recent years, is that value, because of its underlying volatility, kind of swamping everything else. So the performance of anything that is almost multi-factor is almost kind of more positively correlated to the value factor itself than sometimes with the underlying components. So that is questioning again for us in terms of our research, in terms of how we look at factors, especially in periods where one of the factors has such a strong period of underperformance and its performance kind of almost swamps how it behaves, swamps everything else, is that how do you potentially develop and grow that approach to make sure that you are allocating risk appropriately if the underlying factor changes. And I guess to a certain extent I do kind of paradigm shift or not, and I think the quantitative easing of the last few almost decades now, it feels, has changed some of the dynamics on the kind of riskier assets. And it kind of has a lot of slush in the system and support being played by that. And how if this has to unravel, and if when it will unravel, what will be the impact? So again, these are things that to your point, is that we always have to be testing and checking if as something actually structurally changed, is not just a point in time.
So is it too simple for me to interpret that when there will be quantitative tightening, that value will come back?
Well, I guess what we will be starting is from a much lower kind of interest rate base than when we've been before, when we've seen when interest rate goes up, maybe potentially value will not work because you kind of have highly leveraged companies. But we are starting from a lower base. And even what we're starting to see is actually this opposite, like for example in the States. So again, kind of the macro environment and impact there will have some play.
Marlies, do you want to add something on value or momentum and the correlation? Or
Well, I think it has been covered quite extensively, but I agree with Ole. When you work with clients and try and find the right investment solution for them, they really need to buy into the solution So we talk a lot to clients about what objectives are they trying to address. Are they looking for downside protection? Are they looking for a more dynamic solution? What are their constraints? How much risk can they tolerate? How good is their governance? So how much buy-in is there in factors when there is a period of underperformance? And it's very important that they really back the strategy and not kind of sell out at the wrong time. And value has been a very testing strategy and has been very testing for quant in general. So it's, but we don't have clients selling their strategy because we kind of work with them quite closely and communicate. So as long as the strategy does what it says on the box, then I think it's quite easy to explain. If you get a lot of style drift because your factors are capturing something, if you have a value strategy which has a lot, or quality strategy which has a lot of size bias, then when there's a market downturn, suddenly your strategy underperforms because the size factor dominates the quality, the defensive strategy. So I think as long as you provide a strategy that actually delivers what it's meant to do, then it's quite easy to explain to the clients, provided they've bought into, the trustees have bought into the strategy.
Antti?
I'll just challenge that what you said, that value and momentum correlation has turned positive. So you linked it to the Quant Crisis 2007, where indeed over a few days they were positively correlated, which is very rare for things that tend to be -0.5, -0.7 correlated. So if you go, anybody can go to Ken French database or our database, go rather AQR.com, thank you. No marketing, but okay, we've got better database. So look at daily returns, weekly returns, monthly returns. Value momentum correlation is negative. It's just over the last year, both have had negative mean return, and that's sort of that's what you have in mind. And I feel bad telling to investors when they say something similar. Oh, so yeah, they have both lost, but if you look at correlations, it looks fine. They have diversified very well. It just both have sort of one has sucked a lot and one has sucked a little. But so somehow so in small samples the outcome has been bad. But again, let's say the crowding stories do tell correlation logic, and that correlation logic has still worked very nicely, even with monthly data and so on. So somehow it's not as bad, but again it's still, you know, this has been bad enough time that lots of post-mortem analysis needed, including trying to understand why the two strategies got a bad year at the same time, which is very rare.
Anyone on factor crowding? Do you feel that being a big investor, that it's hard to actually capitalize on some of the factors?
On factor crowding, I hear a lot of talk about factor crowding. I'm trying to kind of understand it better, what the different arguments are. To me, it seems like some factors are, you know, if they're crowded, they will kind of more or less go away, right? So value, how can value be crowded? I'm just trying to think about what then will happen, right? Because then you should, you know, think about lots of churn in the long short in that value strategy, because then the cheap stocks will become expensive very very quickly if it's very crowded. Whereas momentum there, it could be detrimental if it's kind of crowding. So a bit more nuanced discussion about crowding, I think, would be good. Now it's more like crowding. I feel a lot of talk about crowding is just investors or participants in the market against factors, talking about that, you know, they're crowded. But I think evaluation can be, you know, in the extremes, at least a signal whether some of these factor strategies are crowded. That being said, we spend almost all of our time on getting the strategic loading on these factors right, rather than trying to time them at all.
Anna?
Yeah, I'll kind of follow from that, really. I guess sometimes when people talk about crowding, they're actually talking actually saying that one factor is looking expensive, so it kind of like somehow proxying that for demand of that factor. But I think, for example, what we've seen over time is quality tends to be at a premium relative to the rest of the market. Defensiveness or low volatility, again, tends to always be a little bit more expensive. So it shouldn't confuse the two. And I guess when we've looked at it and kind of when we use the research of others as well to validate what we think about, we don't really see evidence of crowding. And again, also because again the factor definitions are very different, investor by investor, active quant investor versus a smart beta investor. There's some commonality in some of the academic backing of these factors, but sometimes the region, the starting universe, the combination of factors, especially if you go into something like multi-factor these days, you can have, I'm going to say one factor, but no, one factor is not multi-factor, is it? 2, 3, 4, 5 factors. You can add ESG on top. You can exclude fossil fuels companies. You can do all of these things, and actually you start to get a greater variety in factor strategies and the things that they are doing. So maybe even the kind of the crowding concerns may be even less so going forward.
So Antti, you mentioned the tactical part of factor investing, and it seems like you've a little bit shifted your view, or is it's true, or is it sort of you're still sort of skeptical to the timing part?
Oh, we are, but if I can,
you can continue on Anna's point if you.
Yeah,
like
I do, and valuations are related to both crowding and tactical. So let me just. But so on. I mentioned earlier that I think valuations are particularly useful. I think valuations, correlations, and the third candidate for crowding information is some flow data. And like more and more when we have studied, I've sort of gone back to this realization of how loosely we mistalk about crowding when we think about flows. So like my old Ingersoll book told in 1980s that when you think of crash 87 or think of GFC or whatever, we can't all become risk averse and sell equities at the same time. And so basically you need another side. So if our aggregate preferences on equities change, then valuations will change and returns will change, as opposed to there being net flows somehow. And something similar happens for any kind of investment. This is pretty much true for other asset classes, illiquids and so on. But also these long-short factors. So if something becomes more popular, we just can't see more and more money flowing into that. There's got to be another side at a different price then somehow. So therefore, that's why I think the valuation is so obvious first thing to look at when we worry about crowding. And then secondarily, it's interesting to look at correlations and maybe some pockets of relevant investors that you worry about. So that was just on that crowding exercise. And we just, I mean, myself and I see most everybody talks loosely in a wrong way, as if we could be all selling or somehow doing it. So anyway, so that.
Are you saying the simple thing is that there's a value investor as a growth investor?
Yeah. So market clearing requires that there's not going to be net flows somehow in these things, and we just somehow keep forgetting that. Me too. Anyway, so tactical timing, I think it's interesting. But any attempts that we have done on that show pockets of good results, but not the kind of consistency that we see in terms of 100 years of average factor returns, average 100 years of diversification benefits and so on. You find that something works in timing in certain decades or certain asset classes, but the robustness is really pretty pitiful. And again, with the best things that we find, it tends to be killed by T-costs then in the end. So we are trying to give it the benefit of the doubt, but now when you were, have I changed the tune? Not really. So we are in the skeptical, and we don't wanna sort of sound like dinosaurs who rule it out. If we rule it out, having tried harder than anybody else to give it a positive story that timing works, and we just don't find it.
Can I ask Antti a quick question?
Sure.
If you were forced to time something, would you rather time the equity market or the factors?
Yes, definitely equity market. And so equity market, and it would be multiple signals. And one interesting thing which has been getting especially attention is beyond contrarian and so value and momentum. There's a macro environment, this idea that let's so there's actually the picture I showed there on the growth and inflation, it showed clear patterns, macro sensitivities in the top row for asset classes and much less for the second row for these styles. So there we especially say that if you have got the crystal ball of doing some macro-based timing, please do it in the top row where you have got, you have got relatively reliable patterns. Cliff says it nicely, you have to be twice right. So if you get things right with your crystal ball and then you mess up with that second thing, sort of the contemporaneous sensitivity, that's pretty frustrating. And that can so easily happen in the second row, including, by the way, like value and rates environment. Like some stories certainly would have told that there was a good environment for value last couple of years based on macro arguments, and well, we didn't see that working out too well. So that's, again, macro sensitivities are very weak when it comes to these long-short strategies. So that's why I'm especially bearish on that front compared to asset classes. But more generally also, I'm not big on market timing on asset classes, but rather do it there than with the styles.
Well, just to highlight the point, is this is really hard, right? The timing in the equity market is just really, really hard.
And it's even harder.
If you kind of almost rule out that type of behavior, then starting timing in factor space, it seems, yeah. And it's actually quite a lot of work going into thinking about what the strategic exposure should be. That's not straightforward. It's not straightforward what type of equity share you should have in your portfolio, and then you take it down to factor space. The loading on those, the strategic weights on those. It's not straightforward. And lastly, at least for us, it's really important to anchor this risk-taking at the highest level and explaining the stakeholders what type of risk you have on when you're doing factor investing. If you then should explain the timing of the loading on these factors, if you were to go for timing strategy, I think it could jeopardize the whole factor investing part. So one should think about that as well. Timing value now could have it could have mean that you have doubled up on value a few times because the period has been so long, right? Yeah, so that's something to have in mind before you start implementing such a strategy.
Switching gear a little bit, and Marlies, I'm thinking we talked about value and momentum a lot, and that also what came up in the Mentimeter before we actually started the presentation. So, what do your clients say about the other factors? So, how would you like to put them in perspective compared to value momentum? We talked about defensive a little bit, and there are different names for this. We can call it quality. We can talk about low beta, low vol. What's the popularity among your clients for these things?
I think it's really very client specific. So there's not one solution that fits all. At the moment we see quite a bit of demand for what we call targeted factor exposures. So quite a diversified exposure to, say, value, quality, low vol, size. Momentum is more, depends on the capacity of the fund, whether they can tolerate turnover. And then neutralize everything else, so neutral on sectors, countries, even like certain ESG considerations, because your factor exposures may cause some negative, like if you have exposure to size, you may have a negative exposure on corporate governance. So clients are quite interested in neutralizing that. And there's a lot of kind of dynamics that happen in a portfolio. So that seems to be what we're working on currently with clients. Really more specific solutions and controlling a lot more dimensions of the portfolio. And then it depends a lot on the capacity and diversification requirements of a client. So if you work with the likes of Norges, the capacity is very important and very sensitive to turnover. So that will lead to a different solution from a client that has a much smaller allocation and can either maybe include some momentum or, but it's like really customizing solutions, especially with respect to ESG and governance solutions.
So you mentioned sustainability and ESG, sort of it's high on, I think, everybody's agenda, at least the very Scandinavian, the Scandinavian agendas.
Nordic, I'm a feeling.
Nordic.
Including the Netherlands.
Okay.
Kind of Nordic.
So what's different on ESG integration when it comes to factor investing versus another portfolio, traditional asset class portfolio? Anna, do you want to?
Yeah, I'll start on that. I guess since I've been with State Street, we've always had conversations with clients about ESG, how to integrate it in their portfolio. In the region, the Nordics, a lot of the time it's been around exclusions. But what we've seen more and more is people wanting to make a positive difference in the sense of tilting it to better rated companies, depending how you measure them, right? And you can even make a difference between what you want to see on your developed markets portfolio versus what you might want to see or push for change in your emerging markets portfolio. But what happens with ESG, even with the best will of the world, and we don't really have the same data sets that you'd have when you talk about factors. I certainly don't have 100 years of ESG scores to test over time. So I think the burden of evidence to see is ESG a factor on its own? Is ESG or is a good ESG portfolio or good ESG tilted portfolio share some positive factor characteristics? Quality, low vol tends to appear. But what we've seen investors do is that we all know the direction of travel. Integration, awareness, tilting, exclusions, it's part and parcel of all our discussions these days. And I think what investors sometimes are doing, which we've seen again, but across Europe, is okay, I need to do this ESG thing. Sometimes they believe in it, sometimes they don't, but they are forced to do it because of regulators or stakeholders. But actually, I don't have a lot of evidence, but at the same time, can I use the evidence and rely on the factor evidence, which has a longer history, and somehow maybe if I combine both, I avoid what we tend to call kind of regret risk, right? So if I try to push my returns or try to improve my returns by moving towards factors, even if I might give away a little bit, which again is not proven, is not certain, by having an ESG awareness or an ESG integration, I can more easily, again, within the construct of my own governance and diligence and individual characteristics, maybe I can move this theme forward as well as not just kind of a return enhancement over time. So what we've seen sometimes investors do, even if the evidence around ESG from a reward or return perspective, you can't convincingly say it's there for the same length of time as equity factors. You see investors combining it as a way of trying to improve it and incorporate it in their portfolio.
So simply put, how different would a certain strategy, a certain tilt or a certain style be having some type of screening on ESG integration? Sort of how different is the portfolio?
I guess it will depend on what you'd be screening for. And again, you'd see, for example, here in the region, you'd see around kind of UN compact principles or the breach of the UN compact principles. And that actually tends to be a scattering of companies across multitude of sectors. So you don't see as much of an impact of that. But the problem, or it becomes more complicated when you start to exclude complete sectors like tobacco or fossil fuels, and I always have to look to OC when I talk about fossil fuels. But again, so when you do that, then you have more limitations in terms of maintaining your factor exposures as you'd like to have them, because you are removing a bigger chunk of a very idiosyncratic chunk of the market as well.
So responsible investment, as we call it, ESG, is of course very important for the fund, but it doesn't really impact how we think about risk factors. So we screen the whole portfolio, no matter what type of strategy that lies behind the names, at a regular basis to see if something, some red flags, and then we go in and look into it in closer details. So it doesn't really have anything to risk factors per se to do. That being said, in some markets, the strategy we run in those markets is key in our responsible investment framework. So in typical frontier markets or emerging markets, we use locally based external managers. So they take the capacity in those markets. So we don't apply risk factor strategies on top of that in those markets. So it has an impact that way, that we're choosing a different strategy in selected markets.
Maybe I'll say, so just the framework of factor investing, systematic investing can be helpful for measuring then this ESG exposure. So whether it's scoring or exclusions and constraints and so on, that you know, like the systematic process just makes this easier. So some possible things are that you wanna target certain overall score on ESG or some carbon footprint or some improvement on that or so on, and that can be done so well with this framework. Or you can then ask a question, so what's the financial benefit or cost possibly, and again benefits tend to be most obvious with the G and as Anna said there, the governance and quality, that intersection there. But I think this is something which, I don't know, gives an edge to factor investors. They are not just talking, but they can show some transparently measurable ways what they are doing and achieving.
So there's been a lot of focus, historically at least, on the equity part. And though we've seen also that there are other asset classes, we can have fixed income generally, we can have credit and so on, commodities. Is there anything different in factor investing for equity versus the others? Who would like to take that?
Well, we've recently launched a WIGB index that's climate adjusted. Mm-hmm. And it's quite interesting because it's a similar philosophy, but it's quite different. So the bonds have a longer maturity. So I think generally it's agreed that carbon risk is not priced, but in a couple of years the pricing may change. And bonds have a longer maturity, so they may fall in the bucket where climate risk is more important. So what this model does, it has like three risk factors on which it adjusts each country in the index. One is like the transition risk, which is how much does the country still need to reduce its carbon footprint to achieve the 2% 2-degree target. The other one is like physical risk, so is there risk from sea level exposure, the Netherlands, or natural disasters? And then finally, resilience risk is like how well can a country cope with any disaster? And it's quite an interesting approach because suddenly you can look at the country level in the bond index and decide how much risk you want to allocate relative to your global bond market. So you could equally weigh the risk factors or apply some different risk measurement system. But it's very popular. It's like people are quite excited about it. So.
Antti?
I think with fixed income, with corporate bonds in particular, which has finally gotten some traction. Like same ideas tend to work, the ones we've talked about here today, tend to work also on paper in corporate bond selection. But there's a totally second layer of questions, which in equities also we think about liquidity and trading costs and so on. But it's a much bigger question. It could be that there are wonderful paper results in corporate bonds and you can't implement anything. I think there's a big suspicion by many investors that that's exactly the case. And so there's a second layer of research that needs to be done on sourcing the liquidity when you just can't get those sort of bonds, how that's done, and so I think
we need more research.
You need more research,
yes.
Yeah, definitely. Yeah, that's it.
And more efficient marketplace, right? Lower T costs, perhaps. But to add to the T cost challenge, I think back to this, that it's probably slightly more difficult to anchor with the stakeholders because it's starting to be familiar in the equity space, but it's less familiar in fixed income space. So you have a slightly challenger communication task, I think.
On a final theme here, I'm curious about the actual investment vehicles or the products, and thinking about we saw in the questions before here that it was seemed to be long only. There were mutual funds. But we have an innovation, which is ETFs, which have really taken the industry. We have the hedge funds. Who's going to provide factor investing in the future?
I guess what we've seen is probably more kind of for larger investors, potentially on segregated mandate space, especially because we're getting an increasing level of customization. So again, your starting point is what the client has, and again, what else do they want to achieve by this additional allocation? Is he going to replace something? Is he going to add something to the portfolio? So on the kind of a segregated basis, which is sometimes runs a little bit more invisible to the outside world, but there's a lot of it happening there. So in terms of either completion of what exists and or new allocations or whatever it may be. But we're also seeing a lot more in terms of kind of mutual fund space, as you would have seen from the answers to the queries earlier, the questions earlier. I think what happens with ETFs is that we tend to see them not being used as much by the institutional investors, but maybe what we would probably categorize as more kind of intermediary. And there, what's happening is that from an asset allocation, an allocation perspective, and the belief that they can do timing. So that's when we're starting to see investors use those ETFs, because again, it's kind of an easy in and out to do tactical allocations. I'm not sure, again, we'll have to maybe have more research to see if they're getting it right, but that's what we see the uses of it on the ETF space. These are not long-term holdings of a portfolio. These sometimes tend to be for an asset allocator, a fund of funds or wealth management to do some sort of timing, allocation, and potentially more on the tactical side rather than strategic side. Because ETFs still end up being more expensive, especially for the longer term compared to mutual funds for investors to hold. So sometimes what you do end up seeing them is being used for short-term tactical and to give a certain tilt to, I know, maybe they believe value is going to come next week and put the trade in this week. Or we're using sectors instead of factors as well to try to capture that.
So going from the academic paper portfolio down to an investable portfolio and then down to different products to the retail market, sort of how much is left in returns?
For the average person on the street, probably not a lot in the end, because in terms, if you think about what they can actually access, what they can actually call their broker and buy, between broker fees, entry fees, management fees, there's a lot that has to be paid for with that, what is left over of a long-only portfolio. And what we are starting to see is again, there is especially if you are looking at your pension fund, the DC schemes, you're starting to see the use of factor building blocks in there. And again, prices have come down substantially. But for most investors, and I think he was Buffett that said it, again, just go and buy the market, and don't try to time it, especially with factors, and buying into some of these vehicles end up being too expensive. And then if you try to time it, again, all the transaction costs or T costs will just kind of eat away any potential outperformance. Someone else here?
You hesitate?
Yeah, well, it's like I'm thinking it is a real challenge. Like so with these different vehicles again. By the way, we didn't say there are also bank products which are sort of a one possible approach. And so for once somebody decides, I want stock selection value as opposed to this broader thing. You can think of all these vehicles, and then there are going to be lots of candidates that you can take, and it's a real challenge that then trying to pick among them, because there are many of them, and there are subtle design differences which are going to drive the return differences. They're surprisingly heterogeneous. So this is people actually who are investing in these things, they are frustrated. I bought value, and this whatever pharma friends went up, and then you have got many went down, or vice versa. So somehow so much heterogeneity there, which is due to rather some design choices, like whether you included small caps, whether you did industry neutralization, and So so trying to do due diligence, and besides just looking past performance, which could be related to this performance, it's just so complicated. So I think large institutions have some chance in that they have to sort of take their due diligence efforts from the traditional world into quant world and try to do something useful there. I think the retail is just going to do some return chasing and probably sort of hurt itself on the way.
All right. I think we should let the audience have a chance to ask the panelists questions. Anyone who would like to give? Jules?
So there was some recent work, I think, by some researchers at Duke University that have tried to see how much investors are indeed getting from the factors. The interesting thing was that a lot of people here in the survey said, how do you get the exposure through regular mutual funds? And indeed, the results from that research was that regular investors don't get anything. So if you want to get exposure and get the premium, that's certainly not the way to do it. But the question I had for the panel actually is different, which is, I've been really struggling to understand and also explain to my student what actually the purpose of ESG investing is, in the following sense. We all understand that we can maybe feel better if we invest in those things, but suppose that the goal is that you want to punish those activities and that you therefore want to get rid of those activities, and you would actually manage to get their prices down, their stock prices down, by actively blocking them or not taking them. And now there's another investor that takes that undervalued stock, buys it and collects the cash flows and makes very large profits out of the fact that we are unwilling to hold those stocks. What have we then achieved in the end? Or if a private equity company takes the firm off the market because it's now so undervalued and then takes the cash flows. So is ESG actually the right way to get rid of these activities if that's the eventual purpose? Or is there another purpose to ESG investing that I am missing? I'm not understanding what the eventual goal of this whole exercise is.
I guess again, sometimes there's definitions. I guess there are a couple of things at play there. Sometimes it's definitions, and sometimes it's also kind of time horizon. I guess what we would kind of call ESG or ESG investing is the belief there's non-financial information that will have an impact on prices, right? There is an underlying belief in that. And it will have an underlying effect on prices, either from a kind of risk minimization or kind of return enhancement. That's potentially what you could see there. Both or either could be at play depending on who you look at. And again, what I guess the idea is that if companies are more efficient, if companies, for example, they've got better supply chain and they manage their water more efficiently, and there is some sort of better margin, right? Then over time there should be a transmission mechanism to their share price. They should be rewarded by being potentially more efficient. But they will only be more efficient if bad behavior is potentially punished. And bad behavior can be either punished by the legislator, right? You can impose fines, or increasingly so by the consumer, right? I was reading about Doc Martens and their vegan boots. So apparently they've been very popular, right? So what you're starting to see is that consumers are starting to vote with their purchases, right? So in that idea, then you are seeing the transmission to the kind of end of the share price of a better, however you want to qualify it, however you want to categorize it, some sort of awareness of an impact in the broader society, be it E, the S, or the G, right? So I think what we're starting to see is potentially, and again, this was a niche area. And then again, outside of most investors, not necessarily kind of looking at this in detail, but through either regulators, for example, in France, forcing pension schemes to disclose what's their carbon footprint. So now you measure it, you can compare it, and you can contrast it, to actually consumers behaving in a different way because they have an awareness of that certain behaviors will have a negative impact in their, I guess, overall future and society, I would say. So again, do I have the same level of evidence as Antti has in this 100 years? We do not. But I think what we may also be seeing certain things that we will have to do as a society that can't be accounted for or will not be found in history, right? As we are potentially at an unprecedented time that we want to push for change, and we talked about carbon and carbon reduction and climate change, that maybe we're going to have to do something, and that will not be quantified in any model, despite all the good research that you guys do. So
you have to bring it home to the students.
Yeah.
There was a question over here.
Yes, I have a question about intangible capital, because in our current knowledge economy, the intangible capital, for instance, technology, R&D, and so on and so forth, has becoming a more and more important input for all these listed companies, right? So my question is whether the financial industry professional practitioners actually are actively considering incorporating intangible capital in factor investing, and what is current status in this regard from the industry?
Who want to give it a shot?
I suspect that is too specialist question. I don't have. I do have one sort of cute factoid that I have heard that like there is, you know, I think that's in the spirit that things like book to price are obsolete somehow in the modern world now then, and so, but somehow when you go back and look at in which industries has, for example, book to price performed well as a value indicator, IT is quite high up in that list. So somehow it's worked well there. So which is a weird thing, and maybe it's a sort of 1 over PE effect. But so there somehow value signals have worked somewhat despite this problem, and hopefully there's something that can be done on that. But I do not. I'm not our own expert on that, and I don't know of the literature now really what has been done on that.
I can say that I'm interested in intangible capital, but I don't link it to risk factors, but we have done some pieces on it, linking it to the profit margins and how profit margins have developed over time. So it's more like I put it in a kind of a macro topic in-house that we're looking into, and to understand how the profit margins have developed over time, and perhaps also risks to the profit margins going forward. I'm happy to have a chat with you later on intangible capital in that sense.
We have room for one more question. Michael?
Yes, I have a quick follow-up question on what was just discussed about if the panel has a view on if there's different ways to measure value, or if book to price is still the way to go, because it was kind of brought up, and of course you could measure price to earnings or other kind of ratios. Is there any views in the panel about alternative measures, or should one average across different measures, or is book to price still the way?
I guess for us around smart beta, again, kind of simple, transparent harvesting of factors over time, we use a composite measure, and again, we're trying to get it broadly right without being accurately precise. When I look at our active colleagues, they will have a more nuanced approach to value. They will also have more sector-specific metrics as well, because again, book to price, again, or for certain sectors like financials, again, makes less sense. But even if you do a blunter tool, like book to price and a more composite measure, then you kind of broadly in the right direction and broadly in the right space. For a further refinement, for a further enhancement, you kind of go into the kind of more active quant land, and that kind of further sophistication, which they do, but they still use book to price or price to book. How would you call it?
All right. We had a final question at the Kent.
Talking about value versus the argument versus ESG, for example. Let's say then that we're in an economy where the structure of the economy changes faster and faster because of technological development. So what would happen in such a situation is a lot of companies that used to be very big and very strong are becoming dinosaurs at a faster pace than we're used to. A super easy example of that would be coal mines, for example, or fossil fuel in general. These are going to screen then, I presume, as value on a lot of the traditional measures for value. How easy or how difficult is it to keep those effects apart? And could this be a reason that value hasn't been performing as well because there's structural changes going on, and not everything that looks like value is really value today.
Okay, I have two answers. So mitigating that problem, that's fair. Basically, value contrarian strategies are always short the structural change. And so you wanna try to do something about that. And one idea is that you diversify value with momentum, and then that's gonna mitigate things somewhat. Another one is that you do most of your stock selection on an industry neutral basis if you think that it's gonna be across industries where the structural changes happen. Again, there might be some other structural changes that will cause a dinosaur situation. But again, so there are some things like this that you can do. I don't think there's otherwise an answer to that one. That is the typical vulnerability of contrarian investing.
Yeah, just agreeing, sector neutrality, region, country neutrality, if you apply that, can take away some of it. But it's exactly things like that one should be always looking for to see if it's something structural is changing that can have a very persistent effect on the factor performances.
All right. I think we should thank all the panelists for providing this discussion.
Thank you.